I'm going to show you 3 UK stocks to buy in January 2021, including one that I personally hold in my UK investing portfolio. And if you find the video useful or discover a new stock opportunity, then please consider dropping one of these to support the channel. The first stock is a higher risk growth stock recovery play listed in the FTSE 250. They design, manufacture and sell chemical, biological, radiological and nuclear respiratory protection for the military, law enforcement and fire markets worldwide. This stock is named Avon Rubber, or the ticker symbol AVON. They have 870 employees and a market capitalization of £1 billion. When looking at the price to earnings ratio of Avon Rubber, we can see that it is far higher than both the industry and the markets, suggesting to me that investors are either more willing to pay a premium for less earnings in the stock, or that they have very low profit margins temporarily. So when we compare their market capitalization, the size of the listed company and all of the shares combined, to their net assets, which is assets minus liabilities, we can see that they have a price to book ratio that is also higher than the industry and market, which suggests that investors are simply just more bullish on this company compared to their peers in the industry, or even competitors in the market. In the last 5 years, Avon Rubber has managed to grow their earnings on average annually by minus 9.8%. And this is where the recovery play aspect of this stock comes in, and it really is dependent on whether they are able to reverse this negative earnings trend. Although we should really notice the fact that the reason why the margin is so low is due to their most recent acquisition. So it's not like they are struggling with profitability, it's just they've had a one-off loss that has temporarily reduced their earnings margin. However, what we can see is over the last few years that their earnings have been decreasing, although revenue has been increasing. So as long as they're able to reverse this, become a much more better company, then this could be a great investment or an opportunity to buy. It should also be noted that free cash flow is currently negative despite being profitable, and this could cause some concerns, but I am confident in the outlook for the business. Avon has a fantastic balance sheet with their short-term assets outweighing their short-term liabilities and long-term liabilities combined. They have a limited debt to equity ratio of only 17.2% and a very strong cash position of £147 million, meaning that should their earnings for whatever reason continue to decline, or the fact that they didn't get that contract that has been delayed by a year, and if this continues to halt progress, then they have that cash position and low levels of debt to know that the business will survive in economic uncertainty or even tough times. Their dividend currently yields 0.85%, typically paid in March and September each year. In the last 20 years, they've managed to pay a dividend all but 2 years during the peak of the great financial crisis. But in the last 10 years, they've managed to grow their dividend by a compound annual growth rate of 33.55%, which is truly tremendous growth, and you'll struggle to find any other companies growing their dividend at this pace in the UK markets. One company could be Ashtead Group, although they've halted their most recent dividend and only grown it by inflationary levels. However, they had a history of strong growth. Another one you could probably compare Games Workshop, which in the last 5 years has had very high dividend growth. Avon has rewarded shareholders with 230.4% returns, with dividends reinvested in the last 5 years. However, they are at a point where the company is struggling, and this is a point or an opportunity to buy, even though they are at a higher valuation than I would personally like to buy in, where this could be a point where if they are able to speed up the contract process, really reverse that negative earnings trend, which very likely as it was just due to an acquisition, and they can show, hey, look at us, we can continue growing our revenue, then this could be an absolute winner in January 2021. But over that longer term, honestly, this could be a real strong performer in a portfolio. My only concern is that it's still trading at quite a significant premium and could present more risk involved. However, if you invest consistent small sums of money into this company and slowly build up your position, you'll take advantage of all the peaks and the troughs, allowing you to get the best value on your money. And if you like value, you can get a free share worth up to £100 when you deposit just £1 using my Trading 212 link in the description down below, or the promo code at the bottom right of the video. Bottom left, sorry, I don't know my lefts and rights apparently. The next stock is a low to medium risk dividend growth stock listed in the FTSE 100. 100. They provide and engage in market infrastructure businesses in the UK, US, France, and internationally. The stock is named London Stock Exchange Group, or the ticker symbol LSE. They currently have 5,000 employees and a market capitalization of £32 billion. The price to earnings ratio of LSE would suggest that they are trading at a significant premium compared to their peers in the industry or even the market, although this is likely due to a few compound factors that I'll talk about later in the video. Furthermore, when we compare their market capitalization to their net assets, we can also see that their price to book ratio is higher than their peers in the industry and market. Although I imagine this is due to them being a financial institution, therefore by legislation and regulation, they are forced to have some liquidity so that perhaps for whatever reason that they have that emergency situation occur, they can then force liquidity into their market infrastructure business. Although I'm not entirely sure on this, but this could certainly change the look of their price to book ratio. What we can see, however, is that investors are more bullish on the company. They much more believe it, and therefore they're more willing to pay a premium for less earnings in the business. In the last 5 years, LSE has managed to grow their earnings by, on average, by 15.7% each year, which is truly impressive, although over the last 3 years, their earnings have declined. This is because they've had a one-off loss in their latest financial report in June 2020, which would have been accounting for £230 million. And this was likely written off due to the pandemic crisis, suggesting to me that as long as they're able to continue growing their earnings at the pace they had done in the past, then this can really be a much higher quality stock compared to a majority of the large UK capped stocks, typically those with a higher weighting in the FTSE 100. LSE has a great balance sheet with their short-term assets outweighing their short-term liabilities and long-term liabilities, although not combined. However, they do have a slightly higher debt to equity ratio of 53.6%, although this has decreased in the recent years, and it is acceptable as their cash flow more than covers it. But also their cash position of £1.7 billion negates a majority of that debt should they, in an unrealistic situation, pay it all down with their remaining cash, leaving them in a very risky position. LSE currently yields 0.8%, typically paying in May and September each year. In the last 18 years, they've paid and grown a dividend every single year. You may look at 2014 on the graph on the screen and think, well, that looks like a cut to me. This is due to a difference in dividend payment dates, meaning that the graph is just actually inaccurate, or it's not even the graph's fault, but because the dates have changed, it means it looks like it is less. It's just a visual error. In the last 5 years, they've managed to grow their dividend by a compound annual growth rate of 25.41% each year. LSE has returned shareholders with 278.3% with dividends reinvested in the last 5 years. However, it is largely expected and partially confirmed that the acquisition of Refinitiv will end on this month. And this is where I think there's an opportunity. You could either wait until the acquisition is complete and hope that perhaps it becomes undervalued at that point, or you could start putting equity into it now and really take advantage of it if the stock does go up over the successful acquisition of Refinitiv. Refinitiv gives them the opportunity to become a whole other beast, and this means that they are able to more than likely increase their revenue streams and earnings growth. Refinitiv has much higher profit margins than the London Stock Exchange Group, and under more stricter, tougher management, they could certainly be an absolute winner. And it also increases their connections to Asia and the US, and hopefully they can integrate their systems so well together that this could certainly provide an excellent synergy and therefore an excellent opportunity for shareholder value in the future. The last stock is a company I've not mentioned on this channel ever before. They are a much higher risk growth stock listed in the AIM markets. They provide testing and measurement products for telecommunication networks in the UK. This stock is named Calnex Solutions, or the ticker symbol CLX. They have 82 employees and a market capitalization of £111 million. The price to earnings ratio of Calnex certainly suggests that they are trading at a much higher premium to the market, although when compared to the industry, it is only slightly higher. They have recently gone public public, and I think it was on October 12th, so this is likely to fluctuate a significant amount, especially when accounting for the AIM market volatility. Although their price to book ratio is considerably higher than both the industry and the market, suggesting that investors are more bullish on this stock than the others in the industry, but also much more than the market. In the last 4 years, they've managed to grow their earnings by 22.4% each year on average and maintain fairly consistent profit margins of around 11.8%. But these margins, the main thing is they seem to scale with revenue, and so as the business grows, perhaps they grow to a £1 billion market cap, which gives you a 10 times potential return on your shares, that their earnings should scale with it and therefore create a lot of value. CLX has a great balance sheet with their short-term assets outweighing their short-term liabilities and long-term liabilities combined. They have a low debt to equity ratio of 22.4%, which has been decreasing over the last few years, and this is combined with their fairly impressive cash position of £4.5 million, which more than covers the debt. As I said, Calnex Solutions has recently gone public, so it may take a while for their stock to be accurately valued, and in the market, shares are never accurately valued to an exact amount. So therefore, it could be a difficult one to really enter and start purchasing. I personally like a longer investment time of the stock being a public company so that I can really get an insight onto how they perform. This is perhaps a lesser experienced company and management, but this could also mean that since they are valued at such a low valuation, that they could be an absolute winner in the years to come. But it's also worth noting that since they did IPO fairly recently, that they are likely going to have a lot more volatility than stocks even on the AIM market, which is known for being very volatile. So do be careful with this one, and as I said, consistent small sums of money, probably the best way to enter this position if you're interested. Regardless, in the last 30 days, they rewarded shareholders by 32.3%. If you're interested in my 10 UK stocks to buy in 2021, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a merry new year.